Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Tuesday, the 16th of May. I'm Daniel Lam, your host for the podcast. One of the FAQs, or rather most frequent comments from my external and internal clients, is the lack of action in equity markets over the last 6 weeks, since the high-profile news on certain US and European financials. By lack of action, they really mean the lack of volatility in the markets. So let's dig deeper today, focusing upon the VIX, i.e. the short-term implied volatility of the S&P 500 index. Now, the VIX has been in the high teens most of the time over the last 2 months. That's the lowest level since the start of the pandemic. What are the key drivers that have been pushing VIX lower? Well, broadly speaking, they are related to market technicals and the micro level related to companies. So in terms of market technicals, there has been increasing equity exposure from volatility targeting funds, as well as from CTAs. These funds are trend followers, i.e. such funds will be buying equities as volatility goes lower, or when equity indices go above key resistance levels. So we have a situation where lower volatility begets lower volatility. Thus, the downtrend in VIX that we've been seeing over the last 2 months. And why did equities go higher over the last 2 months in the first place? Well, on the micro level, profit margins have held up and earnings revision more resilient than was expected. Interest costs as a percentage of company profits is actually at a 60-year low despite all the Fed tightening. Of course, what also helped was the fact that the US economy has been, quote-unquote, following the script, i.e. falling inflation, while growth has been slowing but not collapsing. So what are the main arguments that volatility may head higher? The key one is, of course, the looming recession, which may lead to rise in demand for hedging instruments. Historically, volatility is low in late cycle and picks up as the slowdown in the economy gains momentum. Factors such as the tightening in credit due to issues in the US regional banks is also likely to take volatility higher. Lastly, there's also the debt ceiling debate. VIX is currently lagging the spike in US CDS spread, very much similar to what we observed back in 2011, the episode of US sovereign rating downgrade. In our opinion, this is not an environment to up your risk curve in risky assets. The threat of recession and its impact on earnings is likely to cap gains in equities. We would take the opportunity to rotate into high-quality fixed income in order to weather the potentially deteriorating growth environment. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.